morning, everyone. I'm Pooja Chiprunkar. I'm part of the marketing team at US Freedom Capital, and it gives me a great pleasure to extend a very, very warm welcome to you on this intellectually stimulating morning on behalf of US Freedom Capital and Phillip Capital. So, we would like to thank each one of you to take out time from your busy schedules today and gather here for the panel discussion on global investments, diversification, and the dollar. So let me tell you a bit about US Freedom Capital and Phillip Capital. US Freedom Capital is a boutique investment firm headquartered in Dallas with the Indian head office in Mumbai. And the company provides diversified structured investment opportunities to global investors to earn stable returns with a commitment towards safety of the investors' assets. Phillip Capital is an integrated financial house headquartered in Singapore with offices around the globe, and they offer a range of high quality innovative services to institutional, corporate, and retail clients. So, through the discussion today and subsequent discussions that we have planned across India, we aim to and we plan to get together prodigious thought leaders and investment professionals from across the country and abroad to deliberate on a plethora of subjects like currency diversification, portfolio diversification, dollar investments, macroeconomic factors affecting these, and investment avenues to accomplish these. So, honestly, success is no secret. It's the result of preparation and hard work. And that is exactly what our panel displays today. And it's indeed my privilege to introduce our distinguished panelists here. So, Mr. Gautam Mehra is a partner with PwC India since 2003 and leads their tax and regulatory practice. His association with the tax and regulatory services spans over almost 3 decades. So he's been a member with SEBI's Alternative Investment Policy Advisory Committee and National Direct Tax Committee of Confederation of Indian Industry, CII, and American Chamber of Commerce. Mr. Mehra holds a postgraduate degree in law and financial management and is also a member of the Institute of Chartered Accountants of India. May I request Mr. Ankit Bhandari, CEO India of US Freedom Capital, to please present the bouquet to Mr. Mehra to welcome him as a panelist. Thank you. Mr. Vineet Bhatnagar is the Managing Director and CEO of Phillip Capital India and UAE. He has over 25 years of professional experience in banking, financial services, and technology. He has served as member of the Risk Steering Committee of SEBI in 2008, the Governing Council Derivatives segment of BSE, the Derivatives Executive Committee of NSE from 2005 till 2007. Prior to heading Phillip Capital, Mr. Bhatnagar was Managing Director at MF Global SIFI Securities and MF Global Commodities India Private Limited. Mr. Bhatnagar holds a bachelor's in electronics engineering and is an alumnus of the reputed Indian Institute of Management, Ahmedabad. May I request Mr. Bhandari to welcome our esteemed guest, Mr. Bhatnagar, with a bouquet. Thank you. Mr. Stanley Bradshaw is the Global Director and Chief Executive Officer, US Freedom Capital. He has over 35 years of experience as an entrepreneurial leader. In 1990, Mr. Bradshaw founded the Bradshaw Group and sold the firm to a revenue of US $350 million over 22 years. He founded a tech company, a technology company in Dallas, and the company holds a 5-time recognition as a Dallas top 100 company, and Mr. Bradshaw himself is a 4-time Ernst & Young Entrepreneur of the Year finalist. He is a US licensed investment banker. May I request Mr. Bhandari to please present the welcome bouquet to Mr. Bradshaw?
Thank you. Oh.
Mr. Arindam Sengupta is Deputy Chief Investment Officer, US Freedom Capital. He has over 12 years of experience in asset management across India and North America. He has also worked with Reliance Capital Asset Management Mumbai and Citadel New York. He completed his undergrad from Indiana University and master's from Princeton University. So I request Mr. Sengupta to accept the welcome bouquet from Mr. Bhandari. May I now request Ms. Ela Dubey to set the tone for today's discussion on global investment, diversification, and the dollar. Thank you.
Good morning, everyone, and thank you, Pooja, for that warm introduction. I am very happy and grateful to be moderating today's session with some great thought leaders in the finance industry, representing both India and the United States. US Freedom Capital and Phillip Capital have thoughtfully chosen the topic of today's discussion, which is global diversification in the investment portfolio. This is a topic we feel is highly relevant in the context of today, especially keeping in mind the HNI Indian operating in a globalized economy and market. I think it's fair to say that the global economy has been on a wild roller coaster in the past few years. We've witnessed Brexit, we've witnessed trade wars, US sanctions on Iran, and even a massive Chinese debt bomb. In 2018 alone, we saw market volatility return with a vengeance. US stocks saw their worst year since the financial crisis. The rupee continued to depreciate, and crude prices continued to whipsaw. So it has been a time of activity, to say the least. But now, as we are moving forward in 2019, I'm curious to know what trends and occurrences will unfold and what we can anticipate going forward, and especially how this will play into one's investment portfolio and how he or she may look at investing going forward. So the first question that I would like to pose today is to Gautam and Vineet. Could you please share with us the economic outlook for 2019 that you have with respect to India? What do you think we can anticipate to see? So we can start with Gautam.
Sure, thanks. Firstly, thanks for putting me center stage. I know tax is important in India, but probably doesn't beat economics. And thanks for the warm introduction. Makes me feel pretty young. But coming to the economic outlook, while I'm a qualified financial analyst, I'm not a practicing one. But at least from where we are and where we stand, I can share the experience and what we are seeing when we work with clients, both domestic clients and more importantly, international clients. I think we tend to be more critical of ourselves than we should. And over the last 2 years, if I just look at the kind of work we're doing, the growth in our practice, when we're working with foreign clients, we're really, really, really busy. And that just tells me that India, and this bears out by statistics when you look at the foreign direct investment coming into India, India is really center stage today, globally. This is the same sense I get when I go overseas for conferences. I know 10 years back, we would probably be in some breakout session getting 5 minutes to talk about India. We're now center stage. China and India have to be on every global conference that is there, and that makes us proud as a country. I mean, we all know the economic statistics. I'm not going to get into those macro stuff and all. I think 2 or 3 things that happened very well, which gives me more positivity for the future are some fundamental changes that this government has made. We may be pretty critical about GST, but the world is looking at us and saying, how did you do it? Of course, there have been lapses. Mr. Hasmukh Adhia, the finance secretary, revenue secretary, when he was, GST finished 365 days, he was at our event, and he didn't mention on stage that where we really failed, one failure was on technology. Else, we would have seen GST go the whole hog. It would have clearly led to one of the biggest changes that we were wanting to do is to plug all the loopholes and get the parallel economy in. But at least the framework, the groundwork is laid. And it'll be for the next government to see it through. So these kind of changes are not simple. Look at the ease of doing business results. It's conducted by World Bank. We were 150, we've come down to 70. Now that doesn't happen by coincidence. So with all of this stuff, I think at least, I won't say whether it's 2019 because it's an election year, but as I stand and look out into the future, I'm really bullish and positive on India.
Vineet, would you like to add your comments?
Yes, I think rather than talking or restricting our discussion only to 2019 as the economic outlook for India, I think it is more relevant and perhaps even important for us to take a big picture view first. And then, of course, you can always drill down to data, indicators, and numbers, whether it is quarterly or yearly. So just in, pretty much in consonance with what Gautam was saying, I think Asia, and of course within Asia, China and India, is going to be the center stage in the next 10 years. So if you look at the percentage market share in the world GDP, Asia was about 20% 10 years ago. It's about 28 now. And in the next less than 10 years, it's going to break out into above 33% or 35%. Now that is going to be a percentage or market share in the world GDP, which is going to be more than EU and US put together. Clearly, one has come to recognize that the simpler way to predict where the economic growth is going to come about is quite linearly related to the number of people that stay in a particular region, and that's Asia, right? So I think one has started looking at a lot of prediction in the future based on the per capita GDP as a simple metric. And of course, you can make the modeling more complex if you want to. But that being the simple guidance that I'm able to refer to, it is clear that India, China, even Indonesia are going to break into the top 10 world economies by 2030. In fact, 7 out of 10 in an article that got published in Bloomberg are going to be the present emerging economies or China, which is not an emerging economy anymore. So that's the big picture in terms of where this entire strength of growth and therefore the residing wealthy individuals is going to come from, which is Asia. Sure. Look closer home in terms of India, one has seen enormous amount of wealth creation that has happened over the last 15 years alone. A lot of it is related to property, a lot of it is related to hard assets. That may not be true going forward necessarily, but clearly the HNIs and the ultra HNIs in India and the families in India and Asia have started breaking out into the top numbers and top ranks around the world. Clearly for us, 2019 is going to be centered around the suspenseful election outcome of 2019, and therefore it is quite obvious and perhaps a repetition if I say that volatility could remain a part of the first half of our markets. But I would also quickly add that it is good to start looking at what we witnessed in 2018 as a bit of a past, in the sense that we have come out of 2018 in the midst of rising crude, but that has kind of settled down. We came out of a lot of confusion or prediction about the closing down of the liquidity tap by Fed or China or EU. That seems to be taking a bit of a role. So liquidity-driven volatility on the negative side is something that we saw the primary reason for the equity market corrections in 2018 till as recent as December 2018. But coming into the new year, one has started hearing and one has started recognizing that Fed seems to be delaying that, the interest rate hikes. China has started dialing back the shadow banking related concerns on its banking sector to be a little more relaxed, and therefore growth is going to come back, and that is what is going to start reflecting in the equity performance. And there is a lot more that I could add at some other point or some other question. But I think that 2019 is a year when our local HNIs should look to accumulate quality stocks, perhaps even dividend-paying quality stocks, because when there is a flight to safety, and if that kind of volatility were to re-emerge in 2019, that kind of a portfolio would do well. There has been a lot of bloodbath on the mid-cap and small-cap in India in the equity space, so one needs to look at putting together that portfolio on a bottom-up strategy rather than a sectoral allocation. As far as the fixed income market is concerned, I think one needs to be long on the short end of the maturity, short on the long end of the maturity. One has seen the GSAC rally, and therefore now may be the time for us to put together even a fixed income portfolio as far as local markets are concerned.
Thank you. So just to reiterate, it seems like you and Gautam are both in general agreement that there is a global shift happening where India was once in the back burner, but now it's coming to emerge at the front, right? And the seeds for that have been laid now, and predictably in the next 10 years we can see India emerging as a massive superpower. 2019, it appears that a lot of what will happen in the market may be mandated or affected by the general elections coming up with respect to market volatility. But of course, markets are not only affected by what's going on within their own nations, they're very much affected by what's going on internationally. So I'd like to turn to Stan now and talk about our friends across the pond and get an idea from him on what he thinks the 2019 economic outlook looks like for the United States, especially when the US also has an election very close by.
Yeah, thank you, Ela. I would agree with my colleagues here that over the next 10 years, certainly Asia, the Asian region, including India, will continue to emerge as a bigger part of the world economic scene. What we see in the U.S. is it's an interesting time to be there. We are 10 years into a long bull run, and it's not just the stock markets. We've had tremendous economic growth. And the question continues to be in everyone's mind, how much longer can this go? Are we right on the edge? And we faltered a little bit from our equity markets in the latter half of this recent year, 2018. And so as we look forward, what do we expect? You mentioned volatility. This morning's session is not really about politics, but you can't ignore what's going on in the West. There's such a movement of nationalism and populism. It's in Britain, it's in Canada, it's in France, it's in the U.S., certainly in the U.S. with our unpredictable president. And that is spilling over into what's happening in the markets. We have a huge concern about trade wars and what's going to happen. And people are really sitting on the edge of their seat, and it gives us these days, one day to the next, where we have more movement in the markets than we would typically see in 6 months. And it's making everyone very edgy. But if you go back and look at the fundamentals, I think what we expect for this coming year is a little slower growth than we had in 2018. I think we got a nice boost in 2018 from tax reforms that were passed at the beginning of the year. That's a one-time event, so that won't repeat. But the fundamental economic engines of the U.S. economy are still moving in the right direction. So we see continued growth. We think the Fed will continue to inch interest rates up slightly, maybe a little bit less than they did in 2018, remains to be seen. But they're very cautious as they turn that dial. Probably, in my opinion, we will see somewhere near the end of the year, spilling into 2020, a little bit of a turn down. Again, a lot of that based on monetary policy, I think, and very contingent upon what happens with some of the trade tariff disagreements that we're in the middle of. But if that's the case, then 2019 looks really good for the U.S. We are in Texas. In Texas, more locally, we feel very comfortable that our trajectory is outstanding. We have the benefit of being one of the lower cost states in the country, of lower cost of doing business and much lower taxes. And for that reason, we see a lot of companies migrating inside of the U.S. from higher cost, higher regulation states to where we are. And that just the general population growth stimulates a lot of demand in our state. So we, as Texans, we tend to look at the U.S. economy and our outlook, and then we boil it down to what does our world look like in the country of Texas, which we often like to think of, and it looks pretty promising. So with some caution on the political front, we're pretty bullish about 2019.
Thank you. So what I hear is that the country of Texas, or the U.S., and in India as well, it seems like all of the panelists are in general agreement that it will be a bullish year. And it's nice to hear your thoughts about the economies and the markets going forward. Naturally, as I had mentioned earlier, these events will not only impact their own nations, they will have a global impact. And with that, there will also be impact in the markets and in an individual portfolio, right? There will be a ripple effect that will come down to the investor naturally. So I would like to turn now to Arindam and kind of bridge into the topic of today's discussion, which is diversification, and get an understanding from you on what the H&I portfolio looks like in India today compared to 20 years ago with respect to these various asset classes.
Good morning, everybody. So at the onset, I believe traditionally we have been a country of savers. We've had very high savings rate, and it's still very high. It's dropping, but it's very high, I think upwards of 35-40%. Now, how we have invested our savings, so if you go back 20-25 years ago, an Indian HNI, I think, would be over-invested in two asset classes primarily, real estate and gold. Sometimes it would be as high as 70, 80, 85%. In the last 20 years, especially in the last 15 years, the one asset class that has grown has been financial assets. So incrementally, the new money flow that has happened, I would say 50 to 60% has gone into equities, especially Indian equities. About 15-20% is fixed income. And rest of the 15-20% is, I would say, has been split between new real estate, gold, and some alternative assets. So this has been a primary change, moving from hard assets to financial assets.
And why do you think the shift has happened?
I think, to me, one of the main reasons the shift has happened is because real estate as an asset class has slowly tapered off the high growth it was generating. As I meet investors across India, people throw these numbers. Boss, I made 50% in real estate over so many years, 200%, 300%. While these numbers are true, what we don't understand is one of the reasons real estate has given these returns is because inflation has been very high in India traditionally. So, and one of the ways you play inflation is by holding real estate. So, as a country, if we were doing 10-15% inflation, which was the case, then if real estate is growing at 18%, inflation adjusted is only 3%. And as inflation is slowly tapering off, real estate has tapered off. That's number one. Secondly, I think the big asset class, again, which has been created in the last 10-15 years, is equities, right? 10-15 years ago, because of the framework and what was on the offer, rarely people played equities. Now, if you are on any news channel, I mean, the one thing you keep reading about is SIP, SIP, SIP. This whole revolution and evolution that has happened with Indian equities has been great for, I think, investors, and for people who are systemic, it has made money. So that has been a huge wealth creator and driver.
Thank you. So it seems like the average HNI in India has a big appetite for equities. But I'm curious to know, Stan, what is going on in the US with respect to an HNI in the United States? I mean, what does the portfolio allocation look like there? Is it similar to what Arindam described, or would you say it's different?
Well, I think it's different. And if you look back over the same period of time that Arindam was discussing, the 15 or 20 years, I don't think we've seen that much change in the way an American version of Philip Capital would advise their clients. It's the role of the advisor is to know the customer, to assess their risk tolerance, to understand their family situation and their goals, and then build a portfolio that accomplishes those goals. And the key to that is diversification, to have a certain percentage of your assets in a variety of asset classes. It was that way 20 years ago. It's that way today. As a person moves through their working life, through their career life, to their retirement age, then we tend to turn the dial up on the conservative investments, and to turn the dial down on the more aggressive investments, given that there's a shorter term available for these assets to grow and make them less susceptible to the ups and downs in the short-term performance of more volatile assets, like equities, for example. So maybe the biggest thing that I've noticed in the 20 years leading up to today is the granularity of the investments that are available to us. Mm-hmm. We were buying mutual funds 20 years ago, and a person who's 35 years old and married with one young child might be heavily in equities, but it might be several mutual funds. And a person who is 60 years old and with grown children and a home that was fully paid for might be heavily into fixed income instruments. I mean, it's just a pretty simple formula. And that can be done through single holdings, but it's most often done through mutual funds. Today, the number of mutual funds available is 100 times what it was then. Mm-hmm. And you can buy very, very targeted mutual funds, and many people buy very straightforward index funds. So the balancing of portfolios hasn't changed much. Mm-hmm. The philosophy of more aggressive when you're young, more conservative when you're old, that hasn't changed. Maybe just the selection of things that you buy and the way you pinpoint where you invest has changed with more availability and more selection over time.
And why do you think it is that the philosophy hasn't changed? Do you think Americans have learned from certain market events or from massive losses that they need to continue allocating this way?
Well, I think the reason it hasn't changed is because it works.
Okay.
It's pretty simple. There are new assets, there are new financial instruments created all the time. There's all kinds of creative hedge fund strategies, real estate investment trusts as publicly traded instruments give people, the common investor, a way to participate in an asset class that might not have been available to them previously. So there's new creative things available to them, but the general philosophy of not exposing your portfolio to too much risk in any one category has been a consistently performing philosophy. We like, if you meet with any financial advisor in America who is assessing your portfolio and giving you advice on what to do, it'll start with a long series of questions about who you are and what you want to, where you want to be. And then from there, it's going to be an allocation. Some of this, some of this, some of that, and a very strict discipline not to vary from that. Trying to outthink it or overreacting to what may be on the news this morning is a surefire way to blow the whole plan. You just have to have the discipline to think about long term and stay the course. There will be times when one of your asset classes is performing very poorly and it makes you nervous and you need to just look the other way, go back to work and leave it alone, because you're investing for 30, 40 years, not for 30 minutes. And so that's the way we've done it then, that's the way we do it now, and we've stuck with it because I think it's the right way.
You need a blindfold.
It takes discipline. It's not easy.
Yes.
It's not easy.
So from what I'm hearing from your comments, if I were to compare across Arindam's, it seems like a developed economy, such as the United States, versus an emerging economy, such as India, the H&I in the U.S. is better diversified, or has a more diverse portfolio, right, compared to a country like India. And I think it is clear from what we have seen just this past year that an over-allocation to something like equities could do you more harm than good. I mean, there were probably a lot of sleepless nights for people who were heavily invested in equities, right? And we saw that across all geographies. I mean, whether it was the S&P, which was down more than 7.5% at the end of the year, whether it was FTSE, which was down around 11.5%, Nikkei was down 12.25%, I believe. And even if we're looking at Nifty, I mean, Nifty was marginally up, right? So it's clear that stock market performance in 2018 wasn't the best. So based off of this, it is clear that some sort of diversification would have been beneficial, right? Having an upside hedge would have helped in this case. So Vineet, I would like to now turn to you and ask, what do you think an HNI in India should be doing if they are over allocated in equities, right? What do you typically advise your clients or your friends or your associates to do if this is the case?
Okay, so at Phillip Capital, I think we have looked at this entire piece in two ways. I think there was a period of time when we were quite focused on increasing the penetration of an HNI into markets, right? Because we were coming off that traditional way of investing or into real estate and hard assets. And over the last 5-7 years, I think an attempt has been made to let them participate into financial markets. What has happened in the last 5-7 years is that the number of opportunities that are available to participate in different asset classes through the exchange platform itself has increased, which is very good news, right? So today is a situation where I don't have to look at advising our client to take a safety net into precious metals here, such as gold, by asking him to buy physical gold. Right? So there is an exchange platform which allows him to hold gold as a paper. Right? So if there is a heightened global risk that I am seeing, and there is going to be flight to safety, and dollar is going to come under a rout, I can create not necessarily as a 30-minute portfolio, but even as a short-term portfolio allocation. We could now advise them to look at, say, gold through a paper. Likewise, there are opportunities that are available to do interest rate hedging, There is a way to look at currency. If the portfolio for a family office is going to be affected by currency-related volatility and equities, of course. I think what HNIs have also come to understand is that active management of portfolios through many active managers has also not delivered returns, right? So the point that was being made earlier in the passing about the indexed funds or ETFs as a passive instruments, but a way to allocate portfolios into equities has also come up as a way to guide your HNI portfolios. I think the approach will always remain very bespoke. When you look at large HNIs and family offices, you need to understand where the objectives as far as what they want to achieve with their funds. But clearly, in the last 5 years, there is an opportunity now for an HNI to even diversify in currency terms, right? So, for a long period of time, and perhaps even today, we have all been looking at only rupee-denominated assets and rupee-denominated portfolio. I personally started looking at a dollar-based diversification a few years ago for two simple reasons, because I want to participate in a diverged growth characteristic that may be coming from some other part of the world as against my own geography. And second, there may be a natural reason why I could be a consumer of, say, US dollars, right? Whether it is for my travel, whether it is for my business, or whether it is for some expense that I see forthcoming in the next 2, 5, 10 years. So it is natural for me to now start thinking of dollar usage and therefore having a dollar portfolio alongside. And Reserve Bank of India, through its continued effort to allow HNIs to build a dollar portfolio, it is now possible. So today, when we sit with our HNIs, we look at a full picture.
Sure.
What is it that you want to achieve with your money? What kind of objectives you have in terms of your usage of your monies in India, usage of your monies for an international market, and then come up with a construction or come up with a guidance which is reflective of these objectives and goals that the HNI has. So yeah, today there are very many opportunities. Today I think we can do a far more meaningful portfolio construction for our clients.
So compared to what Arindam was mentioning earlier, right, or his outline in the past 20 years of what an HNI has been doing, from what you're saying, it seems like the HNI today is acknowledging that there is a recognizable need for diversification. And in fact, that is being pursued. Gautam, I would be curious to know, from your standpoint, what are the benefits of what Vineet has just mentioned? And what tax advantages would you see in diversification that you would advise an HNI in India?
Like I said, tax is not center stage, economics is. I wouldn't say tax has got any advantages in diversification, but clearly we've seen over the past few years and even now, tax as being one of the drivers of investment towards one or the other asset class, or in the same asset class of investing in that asset class through one or a different platform. And I'll just give illustrations. And the reason is very simple. We all look at returns, and when we look at returns, it's post-tax returns. Right? So if the amount of tax is different across different asset classes, your post-tax return is going to be different. Most of you all would have invested in fixed income through mutual funds a few years back, because there was an arbitrage in tax law. You were getting much less tax deducted at source if you're investing through mutual funds. Income Tax Act, plug that loophole. All of a sudden, we really felt thousands of crores moving out of the fixed income portfolio of mutual funds and moving towards private asset managers, and again getting redeployed there. Of course, the capital gains exemption, which went off now in January, will now mean a 10% more leakage on long-term equity gains that happened. we talk to global investors who are looking at, say, investing in infrastructure and real estate. They were in the past saying, all right, we do a direct investment. But now with InvITs and REITs coming in, which there is no dividend distribution tax if you hold the same asset instead of directly through a REIT platform. And that also goes for Indian promoters. So these are the conversations we're having with clients, and they're saying, oh, I didn't realize this. I'm saving 20% just by holding the same asset through a different platform. A classic example, I was on the SEBI committee, the Alternate Investment Committee. 3 years back, and this is there in the published report, so I can talk about it. Mr. Narayan Murthy, who chairs the committee, first meeting I remember, he went around the table, there were 10, 15 of us, and he said, what is the most critical thing we need to address first? And I think almost unanimous decision there was tax. And they all were looking at me. I said, I've not written the tax law, but I realized there's a lot of work to be done on that front. So we started addressing, the characterization issue. Is this something business income or capital gains? And the tax circular came out on that. There was lack of clarity on pass-through through Category 2. That got sorted. And you look at the SEBI statistics of Category 2. They've not grown by 10 or 15%. They've almost more than doubled every year. And that just shows the kind of push that a certain tax regime can give. And that's exactly the same reason why, let's say, a Category 3 is not put up. We've a lot of investments through PMS, but not as much to Category 3, because there's tax uncertainty, and you may land up getting a higher tax leakage for making the same investment through a Category 3 fund rather than doing it directly in the markets. So I would rather go through PMS rather than go to Category 3. So tax in India has been a motivator of, how do you invest? And it's been important because obviously we've got tax rates going up to 33%. In terms of, just to wind up, in terms of overseas, I think there's no difference in taxation because India follows a global regime of taxation. Every Indian resident pays tax on global income. A couple of queries that we've been, seeing in interesting situations. Somebody sets up an overseas company, invests through there, says, all right, income is being earned by the overseas company. I don't need to pay tax in India. That has changed this last year. We've got the place of effective management rules so that if it's your company set up anywhere, if you're managing it, that company is treated like an Indian company. So you'll end up paying tax on that. And it actually is a double whammy because when you declare dividend from that company to yourselves, you'll end up paying tax again. So the world is moving towards simplification. And last 2 years, we've helped a lot of clients saying just, get rid of those companies and just start holding the assets directly. The other one, which is partly tax-driven, is this whole piece of succession planning. This is big news of last 3-4 years, the threat of estate duty coming in. And therefore, people setting up trust, holding assets through trust rather than holding it directly. So there's a lot of decisions, I think, around investment which are influenced by tax here at least. That's been our experience.
Okay. So even though tax is not center stage, it seems like what you're saying is that the benefits or the post-tax returns, right, or the advantages you reap from that by investing in a non-traditional asset class is center stage in terms of the benefits that are overlooked, right, while making an investment. Arindam, what are some of the other benefits or, things that are overlooked by an H&I while making an investment in a non-traditional asset class?
So one of the things that I do, like every week I meet dozens of investors. Like I literally travel across India and I'm almost catching a flight every other day and I meet dozens of investors. And the two things really stand out as I meet more and more investors. One is we are, as an investment community, we love to be very, very number driven. So when you meet Mr. X, Mr. Y, they will throw these numbers like, hey, I'm making 15%, 20%, 25%. So, and one thing I realized right away is most of us, when we talk of returns on our investment, we are fixated by gross returns. As a country, we are just obsessed with gross returns. We never talk of net returns. A very simple thing, I believe, if everybody is just making 20% net return, that means you're effectively doubling your money every 3 years on your entire wealth. I mean, nobody would be employed. I mean, I would just sit at home, I would not be here. If my money doubles every 3 years, I will not be working. So number one, we talk of gross returns and we don't understand the difference between gross returns and net returns. Number two, when we talk of returns, we never talk of risk adjusted returns, never. Give you an example. So let's take a typical portfolio construct. You tell an investor, hey, how much is your target return? So a good ballpark number people will throw and advisors will throw you this is 12 to 15% return on your portfolio. Now let's start constructing the portfolio. So you have about 20%, depending on how old you are and all of that. You'd have about 20% which is in fixed income, which is giving you high single digit return, 7 to 9%. You have about 5 to 10% in gold, which is giving you low single digit return. You have another 10% in real estate, which is again giving you somewhere between 5, 6, 7% return. Now that leaves your 50 to 60% chunk, which would be in most cases invested in Indian equities. So if you are to do a simple math and try to generate 12 to 15% on this piece, and everything in these line items has given you 5, 7, 8% return, that means on your 50 to 60%, you have to push for 16, 17, 18% return. Now I have run an equity portfolio in the past. I think to give 16, 17, 18% return is crazy. Even to talk about that is crazy. So that means you as an investor don't realize, but you've just taken disproportionate risk on 2/3 of your balance sheet to generate 15%. We just never realize it. You are sweating out the top half of your portfolio at an unrealistic rate. And that is when, so let's see how this is useful, right? Because people over invest in equities because they're constantly trying to match up this return, they will be over invested in equities and in the part of equities which we want to create alpha with, right? So when 2018 happens, when you have a very, very volatile year, you have loss of capital. You don't have underperformance. You have severe loss of capital. So coming back to what Ela pointed out before, if you look at our equity indices in 2018, you will say, okay, Nifty was down 1%, maybe up 2%, small cap was down 5%. But the loss that people have seen in their portfolio is not 1, 2, 3%. There are people who've lost 20%, 30%, just because they are over invested and they don't understand what is risk adjusted return.
So risk-adjusted returns, gross versus net returns, I mean, these are all aspects that play into the learning curve of what a lot of HNIs in India are having to deal with today, right? Whereas what Stan mentioned earlier, maybe 3 to 4, 5 decades ago, this is what Americans were dealing with then. It's something that they've overcome, challenges that they seem to have mitigated. Stan, so you've been working in the investment space for 3 to 4 years in the United States. And it's clear that the United States is quite a mature economy versus India, which is still very, very much, emerging in that respect. Based off of your experience, what parallels can we draw from the example of the US and take with us in the context of India, and what will play out, what trends will play out in the future as Indians start to learn more about a return structure where gross is different from net, or that risk-adjusted returns are different?
Well, it's a good question. If you back up from the discussion of portfolio allocation, kind of take that conversation back a couple of chapters,
Okay.
and ask yourself, why do we do that? And how do you decide how you're going to allocate? The decision is really based on first identifying what are the risks that you're exposed to. And there are risks come in all different types. So we have general economic risks of economies going through growth cycles and down cycles. We have regional risks. So North America is going to behave differently than Europe, differently than Asia, differently than South America. So where we invest, we're taking the risk of a certain region. We have currency risk. If we're invested in only one currency, then our entire portfolio is going to be affected by a change in that currency. We have political risk. So it comes in all different flavors. And if we try to identify what are all those risks that we want to minimize our exposure to, then we go to the allocation question.
Sure.
So if I'm going to allocate my investable assets across a pool of different things, we want to choose those things so that we know we have done our best job of minimizing our exposure to any one of those risks. So we're not just picking bonds and stocks and hedge funds because we like them or because they have a good track record. We're selecting specific ones because of what they invest in. A mutual fund, as I mentioned earlier, there's thousands of choices of mutual funds. Some of them extremely pinpointed on what they select. So you can choose a selection of mutual funds that would invest you in equities. It would be perhaps the equities side of your allocation, but then you choose those in a way that you've diversified yourself against currency risk, political risk, regional risk, industry risk. You don't want to be all in pharma or all in automotive. You want to be in a variety of things. So it all goes back to this whole risk identification and then choosing allocations to minimize your exposure. It means that when one asset class has a skyrocket year, your next door neighbor who is 100% invested in that, he's bragging about making 50% this year. And you didn't. You made 8. And then next year when he loses 70%, you made 8 or maybe 7.5. So you're sacrificing the advantage of catching things on an upswing and the good side of volatility. You're sacrificing your ability to capture that by trading off against your protection against the downside of volatility.
So patience and perseverance, effectively.
Same message.
So it seems that risk is one of the driving impetus, right, for diversification. Vineet, could you give us your comments on the role of an advisor in India with respect to helping one diversify, right? Whereas in the US, it seems like the fundamentals of diversification are clear to an average investor, right? But here we are now starting to learn the importance of that. So where does the role of an advisor play in to encouraging one to diversify?
Yeah, very good question, especially in the context of what we are seeing as a changing regulatory landscape in India, clearly driven by SEBI, our stock market regulator. So I, of course, got into this market at a point in time, and many of you must have started participating at a point in time when you picked up the phone, somebody came across, he had an idea, you liked the idea or you did not like the idea, and that was the entire premise of what you would do with your money. But I think we have all learned the hard way through the bad times and the down cycles and the loss of capital that there is knowledge behind that entire investment process, right? It is important for someone who's advising anybody else or even handling one's own portfolio needs to be knowledgeable and exposed to all the concepts that we talked about here, right? Whether it is gross, net, post-tax, pre-tax, risk-adjusted without looking at risk-related impact on your returns to be understood. And SEBI has started moving towards this entire process to be driven through licensing and through registrations and exams that the advisors now need to necessarily take, which means that here is a way in which market is going to start looking at bringing professionals who have been exposed at least to the theoretical understanding of these concepts. And of course, when they start working and they work in different type of corporations, whether it's a wealth manager or a private banking or a portfolio manager, it is important for these organizations to create the culture of making their advisors understand not only the theoretical concepts, but anecdotal evidences, data related information, and of course, ability to understand what the clients want. So in summary, the role of an advisor, a professional advisor in assisting a client, whether it be HNI or family office, is immense. And this role needs to be understood and discharged with as much responsibility as possible, right? Because handling other people's money, either as an advisor or a discretionary basis, is the centerpiece of creating a sustainable business for financial firms like ourselves.
Sure.
If there are no shortcuts, right? We cannot get away with a poor advice in a particular market, market situation. We need to deliver good advice, good professional advice over a period of time. And that is what will create a good firm, a good client relationship, and obviously a more successful client portfolio.
Thank you. So there is an education process that will go into advisory with respect to the H&I, right? And how that plays into one will invest across various different asset classes, some of which we've mentioned already this morning. I'm curious to know now, though, Arindam, if you could speak a little bit about asset diversification with respect to foreign currency, and in particular the rupee, and where you think the future of the rupee is going, especially with a general election right around the corner.
So, because we promote the idea of dollar diversification, whenever I am asked this question of which way the rupee will go, the first thing I like to say is that currency is a very complicated animal, and I'm not an expert on currency. Well, having said that, I think a very easy way to answer this question is, let's look at the past as very good evidence for the future. If you look at the long-term trend of the rupee, it's gone only one way, down. The rupee has always had a long-term trend of depreciation. Now, within this long-term trend, I think 2017 was a year when it appreciated by, I think, 4 or 5%. So there will always be these years when there will be a bump up, but then the idea is you do dollar cost averaging, right? Just like equities, think of it. You buy Maruti today at 7,500, doesn't mean tomorrow it will be 7,600, day after 7,700, next day 7,800. So why not do the same thing in dollar cost? Also the other idea with dollar, so this is addressing dollar. Now let's look at just dollar at itself. There's two data points I'd like to highlight here. In the last 6 months, we were crunching some numbers. The one thing that is very, very encouraging is most central banks, they have been shoring up their dollar play. They have been buying dollars aggressively. So what does that mean? If 2019 is a year when there is volatility, which looks like it will be, we have major events coming both internationally and domestically, dollar is a safe haven. Dollar conserves value. And again, most of us in this room, let's even think the dollar may not shoot up or down. Let's say dollar is flat. Most of you here, you will have a foreign currency expense. You may send a child abroad, you may vacation abroad. I mean, That is where the dollar comes in. Dollar necessarily doesn't mean you buy dollar investment today and from 1030 onwards it starts appreciating. No, long-term trend. The long-term trend for rupee, I believe, inflation adjusted, has to be on the way down.
So that's a fair argument, but one could come back and counter that, or an average HNI in India could come back and say, well, I don't leave India, right? I mean, I have been living here my whole life. All of my investments are in the rupee. What need do I have to make a dollar investment? But of course, one may forget, that annual vacation that they're taking in California, or the fact that their child has applied for an Ivy League school, at Harvard, or a real estate acquisition that they may have had, right? So these are all things that one may naturally forget. In fact, in 2016 to 2017 alone, Indians spent about roughly $7 billion in U.S. education, right? So that was the amount of foreign exchange going into U.S. universities from Indians. That's around $50 million a month, which is a huge number if we were to look at that. So when we keep these things in mind, I'm wondering, and Gautam, I would like for you to comment on this, does it make sense for Indians to have a foreign exchange pool outside of India to account for some of these expenses that they may overlook?
So I can just, everybody knows the law. You have $250,000 LRS. It's there for now more than 3 years. Just a few experience that we've had with clients. So about 6 months back, I think the US had a window of immigration open, and that required a certain amount of minimum capital, dollar capital, to be available. And then we had a query from a client saying, look, okay, this is over the 250,000, right? And can I club, and can I do this, and can I do that, and therefore meet that requirement? And the answer was no. So this was, one of the things the individual sat back and said, oh, had I done this over the last 3-4 years, used the LRS, I could have done it. So there could be situations like this, which may arise. Coming back to the thing about education and all, the $250,000 by itself, should normally suffice to meet those kind of expenses, vacations, etc. But the point is on diversification, and I think that's an important point to bear in mind, that yes, while one may think that this annual limit that's available is good enough for my vacations and kids' education and stuff like that, there could be situations like the one I described, or somebody wanting to buy a property, which may be more than $250,000, and at that time it gets difficult to all of a sudden in 1 year to try and reach those limits. So we've had questions of saying, look, 4 family members, can I do that? Answer is yes, but then those 4 family members have to be co-owners of the property. You can't just at the back end have 4 remittances going and only one person being the owner of the property. So those are the kind of situations that you have to bear in mind when you're looking at this. So you can't, for example, set up a company and take leverage overseas and then buy a property for higher value. Those things are difficult. So these are the kind of situations we've come across in real life on where clients have thought back and said, yeah, maybe I should have done this. The commercial reasons. Of course, the economic reason or the investment reason of diversification is a separate thing altogether.
Thank you. So I have several more questions that I would like to ask, but for the sake of time, I think we're going to have to cut it short. The last question, though, that I would like to pose is to Stan. So Gautam, you just spoke about your role as an advisor and what you yourself advise your clients, right? Stan, I would like to hear your thoughts on the necessity of having an advisor to help you walk through the landscape of diversification, right? The average, person could argue, well, is it necessary? Do I really need someone to kind of, not necessarily handhold, but to help guide me? Do you think in your mind it is absolutely essential to have an investment advisor, especially in a market like India, where we are now starting to slowly understand that diversification is in fact tantamount?
Sure, that's another really good question. Before I'm an investment advisor, I'm a lifelong entrepreneur and business owner. And so when we talked earlier about economic swings and changes in all these different risk factors that affect investments, for anyone who's ever been a business owner, you know that part of your job is to sort of forget about all those things, because no matter what is going on, as a business owner, you have to find a way to succeed this month and this quarter and this year. When the economy's down, I have to do well. When the economy's up, I have to do well. And there's 1,000 things that we're managing. And for most HNIs that I meet here in India, our primary sales office for our company is here in our company in India, and I come here every 3 months and spend a week or two meeting 5 to 10 to 15 HNIs a day that my team has been meeting with multiple times every week. So I get a pretty common theme of what I see here, and I see a lot of similarities. I see business owners who devote themselves to learning their craft, immersing themselves in what they do to create wealth for themselves in an industry of manufacturing or service or whatever it is they do. And they're smart, and they work hard. But that doesn't mean that they know everything about how to do intelligent investing. In fact, it often is the reverse. People who are really devoted to their business and to generating wealth in whatever it is they do don't have time to study and become experts at proper intelligent investing strategies. So for that reason, for the same reason that an HNI here who's successful would hire a CA firm to help with their, and a tax advisor to help with that complicated part of their business, or countless other experts they would hire to help with other complicated topics that require a specialist, this is no different. And I think if selecting the right advisor is very important. Not everyone that carries an advisor badge is equal. So interviewing and selecting the right one is very important. But then seeking out that kind of advice on their way to strategically identify all the risks, identify your goals and objectives, and then build a portfolio and allocate and manage the allocations on an ongoing basis with a full eye to all of the changing landscape of risk factors and other elements that you need to be cognizant of, it is the role of the advisor. And the HNI should be busy running their business and managing their business affairs, not spending all of their time reading the Wall Street Journal and trying to figure out how to be an advisor. I often say to someone, if a smart business owner could probably buy a book and learn how to conduct an appendectomy, but I wouldn't recommend the self-appendectomy. I would rather go find the best doctor, and I wouldn't shop on price. So hire a good surgeon to do an appendectomy. Hire a good financial advisor to help you structure and manage your portfolio, and focus on making money, not investing the money.
And I think it's fair to say that that landscape, investment advisory in India, is in its somewhat nascent stages. So there's a lot of room for development, right? Just as much as India is an emerging economy and growing, and we are starting now to see the need for diversification, we will also see the need for well-educated investment advisors who understand the space. So I think, to reiterate everything that we've heard from today, there is a fundamental need for diversification. I don't think it's any surprise, whether we're pulling examples from the United States or other well-diversified countries. It is something that will need to happen. We've learned from the past that an over-allocation to any market is dangerous. There is a need for, protecting yourself with some sort of upside hedge. And going forward, as the space continues to develop, we will see a growth in that area. So with that, I would like to now turn to Pooja and take some comments from the audience or questions.
Thank you, panelists, for your expert and unique views on the topic. So the floor is open to questions. Can we have the mics ready, please? Questions from the audience? I hope everyone has had their breakfast. Yeah, okay. Please, sir. Yeah. Sir, please introduce yourself and then go ahead with your question.
I'm Dilip Dalal, economist and financial consultant. Um, if we go back on the global investments, all time what we are trying to do is maximize the profit of the investment that we make. If we go a little bit back on history, international settlements of payments is being done varying between 70 to 80 years time in any one currency. Now, 1940 onwards, before that it was pound sterling, dollar has picked up 40 onwards now. It's about 78 years. The time to meet with a new competition in the currency in the international market. Now, make profits on investments very widely, what we have all discussed. But currency risk, what you earlier mentioned, and you have mentioned also, is to be taken care. What happens now? We have got now a situation for international settlements. A second currency coming in IMF is Chinese yuan vis-a-vis dollar. Two currencies only, which we can settle the international settlements. Now, dollar, we thought in 1970 onwards when the euro came in, a new currency, we thought this currency may be able to compete and create a competition in the settlement of the international payments. But unfortunately, euro didn't pick up the way it should. Chinese yuan has picked up and 2 years back or earlier. IMF recognized that as a currency for settlement. Now, volatility of the currency risk is to be taken care because talking about the India, we had a dollar 40 rupees 3-4 years back. Now we are going with 70. I made profit on that one. If I purchase $1 million at 40 rupees and today I get 30 rupees. Now, this kind of situation will become an American dollar and America also, some of the sources I find that they would like to hedge the currency in a different currency, in different investments in different countries. Now, in that scenario, that the competition of the currency risk, what is to be taken in, how do we handle global investments? Am I here?
You want that question?
Sure. So that's a very interesting question, and I think it woke me up from my sleep. So no. It's time to wake up. So now the same question was asked to me by an investor. I had gone to meet an investor in BKC. I think me and Prosenjit, my colleague, we had gone, and he's an exporter, and he asked me, boss, this is what's going on with China and yuan, and here you are selling the dollar. So I was absolutely clueless that day. I went back to office and I started looking at numbers. And you're on the money on that. So what is happening is, so the dollar a few years ago or a couple of decades ago obviously was the currency of default, right? I mean, you'd always do any payment, anything in the dollar terms, and nobody would even bat an eyelid. Then came euro for a little bit, and now it's yuan. Now, while we talk of the yuan and we looked at the numbers, dollar share in payment, global payment, had fallen to as low as 60% a couple of years back. It's climbed back to 72%. That's number one. That's a fact. Dollar is not losing ground. Number two, every few years you will have somebody once said, hey, there's Bitcoin coming, there's this coming. Every few years you have something new that comes. But the problem with euro, which I think will also happen with yuan, longevity. Time catches up with them. Yuan had this, or Euro had this fantastic run for 5-7 years, fizzled out. Same with Yuan. One of the things why I think the Chinese currency will not hold on, although what IMF likes us to believe, is it's not a free currency, right? You cannot peg a currency and make sure it's a default currency. It doesn't work that way. So yes, while the IMF or a couple of other bodies may say, okay, you can settle with the yuan or some other currency tomorrow, the dollar, I believe, is very, very likely candidate as a preserver of wealth and a default currency. A very basic example, right? I was traveling last year. I was making few international trips. Almost any place you land up, right? Let's say Kazakhstan or Thailand, you can just reach out, pick up some dollars and make a payment with dollar. Nobody will say anything, right? You can pay a taxi guy in Bangkok with dollars. He won't say, try doing the same with yuan. Try doing the same. That's the first thing. For me, dollar will change the day you can actually just pay somebody using some other currency and they will say, yes, yes, that's fine. That doesn't work that way. You can literally land up in any currency with $100 or dollar equivalent and you'd be okay. Somebody will accept dollar. So there is this short-term volatility, but the long-term, I think that dollar is a good preserver of value, and it will stay that way.
I agree with that point that you made. The problem that I have in creating any global portfolio with Chinese yuan as the currency of choice is the way the currency itself is administered and monitored by the government. So that itself is something that makes me uncomfortable, right? Whether you want to call it, it's a pegged currency, there is an overnight devaluation or a revaluation related pressure. That is something that I don't want to advise or do for myself as a part of my portfolio. That's point number one. Point number two is that which is the currency that is the currency for my own consumption, right? For the variety of things that we talked about, whether it's travel, education, acquisition of a property. If it is going to be dollar, then I am going to be inclined to create a portfolio for myself which is going to be denominated in dollar. Third point, am I attracted to China because of the underlying growth in China, or am I attracting to create a portfolio which needs to be denominated in yuan? If I'm interested in actually participating in the growth relating to China, I can very well invest in China through a dollarized instrument, and which is what I have actually done. Just 2 months ago, I have moved into, because there was a lot of correction, you must have heard about all the FANGs and the Tencent related correction. I have moved into a Chinese mutual fund which is run by UBS, which is investing in the Chinese technology industry, but it is denominated in US dollars, right? So you need to see what you want to achieve with this particular global portfolio creation, diversification, and participation. So I hope that.
You will come.
Yeah.
So I wanted
Can-
to add something on this. Though what you said that you have invested in a dollar denominated in Chinese in China. Don't you think that will have a dual cross currency risk for your portfolio?
I think of course you need to be always close to the ground in terms of which way the move is. This is the second time I've gone into China. The first time I had gone into China was actually when the currency had devalued, which was I think 2015. So you have to be close to the ground in terms of what you are going in for, track it for 6, 9, 12 months, and see how it is playing out. This time I have gone into China because of the technology related correction that China and the US American companies had faced. And I'm going to do this as a tactical allocation and come out of it whenever I think it is not going to play out. But this particular phase that I'm intending to participate in is going to be a quick relief rally 6 months, 9 months.
Thanks, thanks.
Rahul.
Question is that we are all aware about the LRS scheme that is there by RBI. Considering that, how much portfolio allocation would you consider to be in dollar-denominated terms by an H9? Say somebody is having a portfolio of 100, what allocation would you recommend to be in the dollar-denominated instruments?
So, whenever I'm asked a portfolio related question, one of the things that I like to draw upon is there's a endowment fund run by Yale, and it's about a $25 billion fund. And there's a gentleman called Mr. Swenson. He runs it, or he's run it for 30 years now. And his 10-year record is about 12%, 20-year is about 15%. And that's stellar, that's tier one. And I always like to see what he has done to achieve these numbers, because a 20-year CAGR of 15% is just hitting the ball out of the park. So to answer Rahul's question, if I was to construct a portfolio with new incremental 100 rupees, let's say I have new 100 rupees and I'm trying to construct a portfolio, I would put, again, dollar investments would be what I would say as the alternate part of my portfolio, and I would put anywhere about 10 to 15% in a dollar pegged product. Why? So this may seem like a low number or a high number, but the idea is, I was sitting with a friend of mine, Hitesh, yesterday. He's here, and Hitesh used a very interesting word. He said most Indians who have 500,000 to $1 million, they are anyways global citizens. And I was thinking about it later on in the evening that yes, so all these gentlemen, they travel abroad, they send their kids abroad. But if you look at their portfolios, it's very local. As a community, right, we are still investing the same way that we were investing 20 years ago, 15 years ago. It's just now we have a little bit more stock exposure. You will have like something else, but we are still buying the same Reliance Industries, the same HUL, right? And the idea is, as you create wealth, that's one journey, but how do you conserve wealth, right? So the idea of diversification is not, diversification will not maybe give you the next 5 million, but if you have 2 million, 3 million, it's a great way of protecting that capital and having a very stable return.
Excuse me. Excuse me. Bit of confusion when you say diversification, and when he said that diversification into different instruments. And as you pointed out, that most of us are having 50% into fixed instrument, gold or real estate. Now, how do I diversify, or how do I create a percentage where I can get more returns?
So, Vineet, you wanna, or should I take it?
I guess once you have made up your mind that you are disproportionately allocated into hard assets like real estate and gold, I guess the only way for you to change the percentage, unless the new incoming incremental monies into your portfolio are substantial, is to actually get out of some of these investments. And I guess the easier and less emotional could be gold as against property for an Indian.
No, my question is mainly that how do I decide how I am disproportionate?
Sure. So,
50% to real estate and gold is a little disproportionate.
Okay.
so the other way of answering this question would be like, so let's say I'm your financial advisor. I come to you and say, boss, let's diversify. So you will do the obvious, right? You will have some money in Indian equities. You will pick fixed income, gold, real estate, right? So seemingly we have diversified. So the first line item, we are all diversified. We have 4 asset classes. Now let's look at the next line item. The one common theme in all these 4 entries is they are all rupee denominated assets, right? And they are directly a play on India doing well, very well, or not so well, right? I mean, this is all in India and in INR. So you are diversified and yet not diversified. So in this, the next level, what I will do is carve out a small 5 to 10% window and make something dollar denominated, which could be dollar fixed income, dollar equities, something like that, right? So because as we diversify, we don't really diversify. We don't. So let's take last year, right? So last year, currency has depreciated 10%, something like that. It went from 65 to 70, 71. So our portfolio, your INR denominated portfolio, forget what you made or what you didn't make, is down 10% in real terms. When you get your mutual fund statement which says 5% rise, that's not 5%, that's minus 5%. So did that answer your question, how we can diversify?
Not 100%, but yes.
Yeah, we'll
some
take
mix
just
and
one
match.
question more. Apologies because we've exceeded the time limit. So, but the team is available for one-on-one
So
discussion.
we are all mingling outside, feel free to ask us
Yeah.
questions, yeah.
Yeah, I'm Anirudh. I advise a few clients. I'm a financial advisor. So my query was on a different line. We are here discussing the product and the likely returns thereon. However, we are talking about a different jurisdiction, and there will be different, tax regulation, different inheritance laws, and the like. So, do you also kind of provide the guidance for the individual investor as to how these things would pan out?
Yes, we do. We
Sure.
So we provide the entire framework, right? I mean, it's not as simple as, hey, let's take your money, put it there. So we do it, everything within the regulatory framework, and we have got all the necessary tie-ups. So, I mean, tax, again, anytime we talk of investing in some other jurisdiction, I mean, people get really wound up in taxation and stuff. It's not that, while it is something we need to be aware of and address, it's not very complicated.
So we can engage.
Yes, of course.
The team is available for one-on-one discussions after the event as well. So I'd like to thank you for gracing the event with your presence, and your questions and enthusiasm made the discussion even more lively. I'd like to thank the panelists, Mr. Mehra, Mr. Bhatnagar, Mr. Bradshaw, and Mr. Sen Gupta, for your expert views and insights into the world of investments and dollar diversification. And I express my sincere gratitude towards the team at St. Regis and Magna Vision for their perfect logistics support to make this event a big success. Thank you, Ela, for the perfect, smooth, and seamless moderation. And there's a feedback form placed in the welcome kit that was given to you at registration. Please fill the feedback form. That will help us tweak and customize the content as per your requirements and better the arrangements made. And you may leave the form on the table. And thank you. The breakfast is available till 12. Please have your breakfast. Have a brilliant day ahead. Thank you.
Thank you.